Good morning, everyone, and thank you for joining us for today's webinar entitled Maximizing Social Security Benefits and Avoiding Mistakes. Like most of our sessions, this will be a 1-hour webinar, and it's being hosted by Counselor Buchanan and Mitchell and May Barnhard Investments, the firm's wealth management subsidiary. For those of you who are not familiar with CBM, we're a full-service accounting and advisory firm headquartered in Bethesda, Maryland, outside of Washington, D.C., but we have a presence nationally. We have team members in Florida, Pacific Northwest, so really anywhere that you might need services in the country. And our presenters today are going to be Judy Barnhard and Alex Seleznev. Now I'm going to read their bios in a moment, and I know many of you have heard from Judy and Alex before. They're two of our prolific presenters. But if you are new to CBM's webinars, or if you haven't worked with us before, you'll consider the expertise that they plan on sharing today. Retirement planning is really core to the services that we offer, and Social Security is a big part of that. So presumably you're here because Social Security is a big deal for you, or it's something that you're thinking about. Hopefully you're not just here for CPE purposes, but I would invite you after today's presentation to reach out to either of them with any questions or concerns you may have. We're recording today's session, so within the next day or two, we'll be sending out the slides, a recording, and then Judy and Alex's contact information. So again, if you need a consult, if they say something today that really is important to you, the point of this session is to really just introduce you to their expertise. And we'd love to learn about you. We'd love to learn about what your situation or challenges may be. So we're looking forward to a good session today. And with that, let me just offer some quick bios for our speakers, and then we'll get going. So Judy Barnhard is an executive vice president at CBM, and she's also a director of professional services, wealth management, and financial planning services. She's chief compliance officer and a co-founder of May Barnhard Investments. In her role as a certified financial planner and a CPA, Judy consults on income tax preparation and planning for individuals, small businesses, estates, and trusts. She also provides advice on cash flow and budgeting, retirement planning, of course, and risk management. She's also, like I said, a frequent presenter on tax and financial planning related topics. And we have two upcoming webinars that she's going to be presenting at, Medicare and the Inflation Reduction Act on Thursday, February 9th. And then we have another webinar scheduled on the new Secure 2.0 legislation on Thursday, February 23rd. So Alex Seleznev is a partner as well, and he's Director of Wealth Management and Financial Planning Services at CBM. He's also a co-founder and the Chief Investment Officer for MBI. He has 15 years of experience providing comprehensive financial planning and investment advisory services. Alex is a certified financial planner, a chartered financial analyst, and he leads the firm's investment management group. Like Judy, he's also another prolific presenter. He's going to be joining Judy for the February 9th and 23rd sessions that I mentioned a few moments ago. And he's also going to be co-presenting on February 16th at our next quarterly market update session. So his co-presenter that day is going to be Joshua Hahn, the firm's senior investment analyst. So, please register for that. Should be a great session. And finally, Alex was also recently recognized as a top financial advisor by Bethesda magazine, and he's frequently quoted in financial media outlets such as Kiplinger. So I'd like to thank all of you for registering. Thank you for those of you who submitted your questions. There is a chat box in the Teams meeting room, so if at any time during the presentation you have any questions, please feel free to use the chat box. We'll be monitoring it throughout the next hour. For those of you that are interested in CPE, we will be launching a series of polls. Let me launch a quick poll here. It's just a test. It should be on your meeting screen, or it should be in the chat box. So again, like I said, we'll be launching 4 of these polls over the next hour. Please reply to 3 of them if you're interested in CPE. The session's being recorded. As I mentioned, you'll get a recording. And with that in mind, I think I'm going to turn it over now to Judy and Alex.
Thanks, Joe. I appreciate that introduction. Alex, if you could actually just go back one screen. Alex and I often talk that we kind of tag team each other. We work together extremely closely on our clients. I tend to focus more on the tax side and Alex more on the investment side, but we work together providing comprehensive financial planning to our clients. So You'll hear lots of us, I'm sure, if you like to attend our webinars. The learning objectives today, we're going to be going over just the basics of Social Security and what things have changed now that we're in the calendar 2023. Obviously, understand the age requirements and when to apply and considerations that you should take into account. We're going to talk about how to maximize your benefits. Alex has got some great slides there on that. If you make a mistake, how to fix it. And then we are going to leave, we are hoping about 10 minutes at the end to answer frequently asked questions. Okay, so with that, the history of Social Security, you know, it's interesting. The Social Security law was actually signed in August 1935 by President Roosevelt. And ironically, the trust fund is scheduled to run, it's out of money, its surplus will run out of money 100 years later in 2035. It's just how it goes, but it's been a very successful program over the years. Right now, the Social Security beneficiaries total over 70 million, and our U.S. population is approximately 332 million. So, you know, 21% of all of the United States population is receiving Social Security benefits. It's actually structured, I hate to use the word Ponzi, it's really a pyramid scheme in the sense that it is supported from the bottom of the pyramid, right? It's those workers paying into the fund that supports then the retirees that are at the top of the pyramid. And hence, next slide, we come to its health. And we got many questions about this from registrants because, you know, the 2022 annual report that was released does basically project that the surplus, I want to underline surplus, will be depleted in 2035, and that's only 12 years away. It currently has a balance of $2.9 trillion in reserves, and it's estimated 182 million workers pay into the system right now. So when we talked about that pyramid, 182 million people are paying into it with 70.5 million recipients. So it's 2.58 workers, right, per recipient, and that's down from 2.7. So you can just see that, you know, what's happening is there's less of a base that's supporting the top, and hence that's causing a crunch. You know, baby boomers retired. Baby boomers are 1946 to 1964, so they're retiring in record numbers, and the birth rates have dropped. So it's just a matter of time that Congress is going to have to act, and you may have heard from our new Republican-controlled Congress that they are going to be taking a firm stand when the debt limit comes up, which is scheduled to be sometime in the summer of 2023. And the Republican Study Committee released its budget plan in June of 2022, and you know they are pushing for entitlement reform both on the Social Security and Medicare side. Social Security and Medicare are the two largest mandatory expenditures that the federal government has. So what are their options? Increasing age eligibility, and what the Republican Study Committee released is pushing the age from 67 to 70. And I think that the articles I've read, they count that as kind of a no-brainer, that is something that probably needs to be done. Also talking about means testing. That's controversial because, you know, those recipients or future recipients that have been paying in, you know, over the course Security reduced because of their means. Raising the payroll tax, of course, the amount that the current workers are paying into the system and the ceiling that is subject to that payroll tax. And they're also tossing around, as you've seen in past presidential elections, the idea of maybe privatizing Social Security for some of the younger workers. The goal there is that it's Congress really wants to be out of the fact that it's a mandatory expenditure and they don't really have much control over it because it's indexed. And so those are, it's going to be, I'm going to say it's going to be a bumpy ride in 2023. you know, the Republicans have a very narrow control of Congress, and of course, there's a Democrat control in the Senate. So I think if you're a federal worker, I wouldn't be surprised, frankly, to see, you know, a shutdown this year. But enough for the political commentary. We'll move on to understanding the basics. Okay, so you have to have 40 Social Security credits to qualify for Social Security, and you earn that credit by earning wages. You can earn 4 credits per year. That's the maximum that you can earn, and it just takes $1,640 of earnings to equal 1 credit. So essentially 10 years, you know, if you want to make sure that you got your 10 years in so that you qualify for Social Security. Spouses can benefit at age 62 as long as you know they're married, and they actually can benefit up to 50% of the higher spouse's benefit if that works for them. And you know, we do. Alex is going to have a couple of slides on this. Excuse me, but basically, spousal benefits are a very important part of planning for Social Security and maximizing the benefits that you'll ultimately receive. Social Security calculation, a lot of people think it's quite a mystery, and it is hard to explain because it's complicated. But here goes. It's the average indexed monthly earnings. So right there means that Social Security's, got a calculation of what your average index monthly earnings are, and it summarizes 35 years of those index earnings, and it will throw out basically the lowest years. Okay, just an example: to receive $2,000 a month, a worker would need to have inflation-adjusted annual earnings of approximately $60,000 for 35 years in order to receive that benefit. We do recommend that you log on to socialsecurity.gov and create what's called a My Social Security account and review it, make sure your employers have been reporting the correct amount of earnings, because that actually will impact the amount that you could qualify for. It also, you might be eligible for some benefits they're not even aware of. So the Social Security site will help you determine that. And just one last comment, some people think that by working longer, their benefits will go up. Generally, that's the case if you're in your high earning years. But if you, have 35 years of high earnings and then you go and take, a part-time lower earning job, that would be probably one of the years that would be thrown out. So it's not automatic that just because you're working longer, your benefits are going to increase. So your full retirement age, we refer to it as FRA throughout this presentation, is going to be age dependent at this point in time. It's 66.4 months. It does increase to age 67 for people born in 1960 or later. And how do you determine what your monthly benefit is? As I said, socialsecurity.gov will give you that information. But the important thing to note here, and we have some examples of it, is that at full retirement age, that's when you get your full retirement, right? If you decide to retire early, in this case at age 62, there's actually a reduction in your benefit of 7% annually. And likewise, if you decide to defer that benefit, so not retire at your full retirement age, but instead retire at age 70, there's actually a delayed retirement benefit of 8%. Now, if any of us can go out and get guaranteed 8% income on our earnings right now in this volatile market, that's a pretty good deal. The caution, of course, is this is a forever penalty or forever bonus. So it's very important to keep that in mind. Okay, next is an update now that we're in the calendar 2023. This shows you what the maximum taxable earnings ceiling is. It's actually $160,200. for 2023, and that's an increase of $13,200. This is an example, as I said, of what some of the tools that Congress has in terms of adding to the trust fund is basically increasing the ceiling of earners of how much when they stop actually paying in the 6.2% payroll tax. So the maximum FICA tax right now is 6.2% times 160,200, which is $9,932. If you're at that ceiling, that's how much you and your employer are going to be paying in to the trust fund. The annual earnings test, if you're under your full retirement age, is $21,000. And in the year of your full retirement, it's $56,000. And Alex has a little bit more on that. The maximum monthly Social Security benefit of full retirement age in 2023 is $3,627. And then you'll see the amounts there for the average benefit for all retired and for couples and for widower. Next page, please. Okay, so as I mentioned, these are the two largest programs, Social Security and Medicare, and they are indexed. They're not subject to the annual budget approval by Congress. And so consequently, with the consumer price index being so high in 2022, Social Security retirees actually received an 8.7% increase starting in January 2023 for their Social Security benefits. In 2022, it was a 5.9% increase, and in 2021, it was a 1.3% increase. And I can just tell you, for as long as I can remember, it's been below 2%, for the last decade or more. So the fact that it's at 8.7 is really unusual. Don't expect that to last. But right now they got a hefty increase. Now, one thing that is important to understand is that your Social Security benefits are taxable for federal income tax purposes. There is an exclusion if you're single and you have a total income of not more than 25,000 or married filing joint of 32,000. If you have total income above that, it's going to be subject to tax up to a maximum of 85% of your benefit. So what can you do about that? Well, tax planning, tax efficient investing, which is something that Alex would love to talk to you about. But it's essentially, are your investment accounts reporting current taxable income, which is then increasing your total income, which is then increasing the amount of the Social Security benefits that you may be subject to tax. Likewise, Medicare, the Medicare premiums, once you join Medicare, is based on your modified adjusted gross income as reported on your tax return, generally 1 or 2 years prior. So to the extent that you're able to reduce your income, you're going to help to reduce the amount of the Social Security that is subject to tax, and also the amount of your Medicare premiums that you end up having to pay. And we are, as Joe mentioned, having a Medicare webinar in February, so I'm not going to go into it much other than just to say that you do not have to enroll in Medicare and Social Security at the same time. So you do need to enroll in Medicare by age 65, and you see there's a 3 months before and after, but that does not force you to make that decision to enroll into Social Security at the same time.
Judy, I'm going to launch the first CPE poll. For those of you interested in CPE, please indicate on the poll that you are here and click the submit button. I'll keep this up for about 25-30 seconds. Thanks.
Okay, so what do you consider before applying for benefits? Well, financial need is paramount, and we recommend that you prepare a budget and be conservative, add for contingencies. The rule of thumb has been, in many financial planning articles, that that the budget that you need post-retirement is typically 70 to 80% of your current expenditures. However, I would kind of argue with that may actually be too low. We have a lot of clients that we see where they're planning for certainly the same amount that they're currently spending because they say they don't want to move to a lower cost state, or they don't want to give up certain expenditures, and in fact they want to add to it. They want to travel. So you want to put together a budget for what you're spending right now and what you anticipate spending in retirement, so that you know what you need to cover through Social Security and through other sources. Maybe you have retirement income, or your investments. So financial need is paramount. Life expectancy, of course, right now for men it's 84, and for women it's 87. Health condition. So chronic diseases, diabetes, cancer, heart disease. If you add in obesity and smoking, I read an NIH article that said that if you have chronic diseases, one or more of these, your life expectancy is likely to actually be 7 to 17 years lower than the life expectancy here of 84 and 87. So you have to take that into account. Genetic history, of course. If you have a predisposition to a certain illness, also your parents and grandparents, what did they die from, or are they still alive, and consider that genetic makeup. Advantage of delayed claiming, the 8% increase if you wait from full retirement age to age 70 on your Social Security benefits is significant. So if you're able to do that, that's certainly worth considering. Spousal benefits. So you may want to wait to maximize the amount of spousal benefits if the spouse with the higher earnings is still working, right? And the spousal benefit, you'd want to wait to get 50% of the higher amount. And so you may want to wait on that. Long-term care needs. If you have long-term care insurance, this is an important factor. Otherwise, please do factor in long-term care needs. We could have a whole nother webinar just on long-term care, and of course the increase in medical costs and the cost of assisted living, whether or not it's outside in a separate home or even in your home. Everything is increasing in that area. 1 in 4 65-year-olds will live to age 90, and 1 in 10 65-year-olds will live to age 95. Alex and I had a client recently ask us to do a projection to age 120. Right. And we said, okay. And she worked in the medical field, and she feels it's very promising that there will be breakthroughs now that the human genome is being analyzed more thoroughly, and that there'll be breakthroughs, and that life expectancy will actually be much higher. And longevity risk is the fear of basically outliving your money. So you can be encourage you to be conservative in terms of projecting how far you need your money to last. Next, Alex.
All right. Well, thank you, Judy, and thanks everyone for joining us today. So maximizing your benefits. We'll have some examples that I'll share with you. Hopefully that will help. So you'll see exactly how you do that. But before we do that, a couple of figures to share with you. So the very top of this slide, which you're looking at, this is the Social Security life expectancy table, or a short version of it, essentially. So if you're a 55-year-old male today, well, your average life expectancy is 82. And if you're a 75-year-old female today, your average life expectancy is 89. And perhaps you already noticed that essentially the way it works, I guess the older you are, the more you expected to live. Now, very briefly, I'll comment on what Judy mentioned just a moment ago. We do have one client who wanted us to run the projections to age 120 for a variety of reasons, actually. But when you look at the averages, sometimes I point that out, let's say age 89. Well, what that means in practice is that half of the population will not make it to age 89. So it's just many people tend to think that they'll go above the average, but statistically speaking, it's actually 50-50. So I'll just make that comment. Now, in terms of your FRA, and Judy already talked about that earlier, but please memorize that number for yourself. That's very important. We will be talking about it in actually every single slide in this presentation. Essentially, if you were born in 1960 or later, your FRA or full retirement age is 67. For those who were born between 1943 and 1954, it's anywhere between 66 and 67. And if you were born prior to 1943, well, your FRA probably doesn't matter anymore because you're already collecting your Social Security benefits. But again, please memorize your FRA. It will be helpful to you. All right, so when to apply for benefits? So what are some of the top ideas to keep in mind, and what are some of the mistakes to avoid? So, as Judy mentioned earlier, you can collect your benefits anytime between your age 62 and 70. And what's important here, it's anytime. So it can be 62, it can be 67 or 70, or it can be 64 and 8 months, if that makes sense for your circumstances, or it can be 68 and 9 months, just in case you wanted to wait to age 70 and then you changed your mind. Now, age 62 is the earliest age to collect your benefits, and if you decide to take it at that time, your benefits will be reduced by up to 30% versus your full retirement age. And I'm just going to assume it's 67 for most people at this point. Now, if you delay collecting your benefits, perhaps all the way to age 70, they'll increase by 8% per year. And what's important here, again, one of the top questions, that will happen regardless if you work or not, regardless of your earnings record. So if you at a certain point, perhaps at the max or not, your benefits will still increase by 8%, which is why it's such an important planning point. Now, one of the top mistakes, and we actually had someone making this mistake last year. So, if you decide to collect your benefits at age 62, or essentially prior to your full retirement age, is this something you should or should not do? Well, that again depends on your personal circumstances, but realize that the earnings test will apply. And if you're earning, I'm just going to say decent income, essentially more than $21,000 per year in 2023, well, your Social Security benefits are going to be reduced by $1 for every $2 in earned income in excess of that amount, essentially $21,000 this year. Now, if you're going to reach your full retirement age again this year, the reduction is going in excess of $56,000. And I'll tell you, in practice, if you're going to reach your full retirement age in the year when you're planning to collect your benefits, well, perhaps you should just wait. And this is, again, a common mistake when people decide that they want to collect the benefits for, let's say, legitimate reasons. They need the actual cash flow, but they forget about the earnings test. So please keep that in mind. So when to apply? So I'm going to say this is, if not the top, it's certainly the top 3 questions we get. What is the break-even point? Should I collect it at 62 versus age 70? What is the life expectancy that I need to assume to make one decision better than the other? Well, the answer to that question depends on your personal circumstances. There needs to be a calculation. We need to consider your tax situation. That is very important. It's going to impact the break-even analysis quite a bit, or sometimes drastically. If you're married, which is something we'll talk about later, that will also impact your decision. But if you're looking for I'm going to say a generic answer to that question, well, that's what you see on your screen. This is directly from the Social Security website. So if you're considering collecting your benefits at age 62 versus age 67, well, the break-even point is age 76. 67 versus 70 is age 80, and then 62 versus 70 is age 78. Well, if you're just looking for an easy number to remember, well, age 78. That's on average your break-even point. But again, in practice, it really depends on your circumstances. So, what are some of the considerations or strategies to keep in mind when you're applying for benefits? Again, you can apply anytime between your age 62 and under normal circumstances. Age 62 is the earliest age, and the maximum benefit in 2023 is almost $2,600. Now, I'll tell you in practice, at least in our experience, relatively few people actually plan to collect the benefits at 62 for a variety of reasons, but then life happens. Let's say, you're planning to collect at 67 or 70, but then there is some kind of illness, perhaps even terminal illness, and that is one of the first decisions perhaps you need to make, financially speaking. Perhaps you need to collect your Social Security benefits sooner because your life expectancy is now shorter. Now, excluding that, perhaps you have some immediate cash needs. So let's say you're in retirement, you're no longer working, you don't have any other sources of income, there's no pension, no passive income of any kind. So why wouldn't you be collecting your benefits? Or your other resources are limited. Perhaps you have a portfolio in place, but you don't necessarily want to deplete it. Or perhaps you're doing it for tax reasons because most of your portfolio is in pre-tax accounts. So that is also one of the decisions to make. And again, even though you don't see it on the slide, it doesn't have to be age 62. It can be age 65, right? You don't necessarily have to wait to any of those specific points. Now, your FRA, the maximum benefit this year, is a little more than $3,600. Just happens that it practice for single individuals, I'll put it that way, seems to be the most optimal. Doesn't necessarily mean for everyone, but for most people. And we usually start with this age as our benchmark scenario. One of the reasons that's the case is because at your full retirement age, there's no longer any penalty for any earned income, regardless of the amount. And the Social Security benefit will likely be taxable if you continue to work, but there's no earnings test any longer. In terms of your life expectancy, the assumption is that it's average, or in other words, you're not willing to make any specific assumptions, which is why, again, we use it as our benchmark scenario. Age 70 in 2023, the maximum benefit is more than $4,400, so significant benefit. And actually here, I'll start from the bottom of the list. The primary reason why you would want to collect, that late is that you expect your life expectancy to be above average. That is usually the primary reason to make that decision. Of course, this is the highest benefit you will receive, and anticipating those questions, it doesn't make any sense to wait any longer. Age 70 is when you should be collecting it. Now, what are some of the other reasons that you should consider? Well, perhaps you're a conservative investor. You look at your projected rate of return, and let's say it's 5%, which is what you're anticipating from your portfolio. From this perspective, if you have this asset, or let's call it annuity, that appreciates in value by 8% per year, well, you'd be better off essentially drawing from your portfolio, especially if you're dealing with taxable portfolios. So as a result of that, the impact is not going to be that large on your tax situation. Perhaps you have other sources of income. Pension would be a classic example. A good quarter of our clients are either former or current government employees. So if your pension covers, let's say, most of your income or a big chunk of your income, well, perhaps you would want to delay collecting your Social Security to age 70. Or of course, if you're still working. Sometimes that's the decision maker by itself. If you continue to earn, good income, you just don't need more cash flow. So why would you want to collect it earlier? Now, one of the things I want to highlight here, regardless of when you decide to take your Social Security benefits, from the perspective of the Social Security Administration, the present value is the same. It's very important. The present value is the same because your life expectancy doesn't change. Now, if you decide to wait, and yes, the benefit, let's say at age 70 versus age 67 is larger, but realize that if you're at the max, just to keep it simple, you're essentially leaving close to $130,000 on the table in uncollected benefits. So the funds are not, working for you. You're not using the funds for travel, gifting, or any other reasons. So essentially what's happening here, that's the opportunity cost. That's the cost of I like to refer to it as gamble on your own life expectancy. And again, perhaps that's not going to be a decision maker for you, but keep that in mind. There is some opportunity cost in place.
Alex, I'm going to launch the second CPE
Please.
poll.
Perfect
I'll keep
timing.
the poll up for about 30 seconds. And if you can't see the poll for some reason, please take the next 30 seconds to enter yes in the chat box. Thank you.
Thank you, Joe. So claiming strategies for married couples, and it's one of the most favorite parts of the planning process for me when we work with married couples and trying to figure out the best claiming strategy for them. So we'll talk about two examples here, two scenarios, and one is more complex than the other. Now, if you don't remember much of what I'm about to say, which is fine, please try to remember this. If you applying for Social Security benefits at the same age as your spouse is frequently not the best decision. So if you and your spouse are going to apply at the age of 67, just to make an example, well, reconsider that decision, because in many cases that is not the most optimal, and I will demonstrate why that is the case. Now, both of these examples are for illustration purposes only. We assume that each spouse will receive the maximum possible benefit. We're not adjusting for inflation, and we're not tax affecting these calculations, because of course all three of those variables will likely have a very significant income impact on the outcome. So keep that in mind. That's why, again, I always say it needs to be based on your specific circumstances, but we're simplifying it here. So in our first example, our husband is 67 years old. He has an average life expectancy of 85. Our wife is 60, and her life expectancy is also average, age 88. So as a result of that, the assumption is that the wife is going to outlive her husband by 10 years. So in scenario A, both of them collect their benefits at age 67. So what happens here, the husband collects the benefits immediately. He's already 67, and then the wife waits to age 67, so for 7 years, to collect her benefit. So the present value for both of them in this case is $1,389,000, which, by the way, is a pretty significant amount if you think of it. Now, can we do better than that? Now, what if our wife begins to collect her benefits at age 62, so 5 years earlier, and when the husband begins to collect immediately, he's already 67? Well, the present value in this case is higher. It's $1,443,000, which is $54,000 more, and that's in today's dollars. I want to highlight that. So perhaps this decision is better. Why is that the case? Well, there are two reasons. The first one is because the wife is collecting for 5 additional years, right, from 62 to 67. And perhaps more importantly, since the wife is going to outlive her husband by 10 years in this case, she is going to inherit his benefit. Again, this is important. If your spouse's benefit is larger than your own, and if you're, planning, or perhaps that's part of the projection, to outlive your spouse, you're going to inherit that benefit. This is what creates this so-called hedging scenario. That's how I usually refer to it. It works it's a very powerful concept, especially when there's a significant difference between the age of the spouses. Well, can we do better than that for planning purposes? Let's say the wife collects the benefits at 62, so in 2 years, and the husband waits for 3 more years and collects at the age of 70. The present value in this case is much higher. It's $1,563,000, which is $174,000 more when compared to scenario A. So I'm hoping, again, I'm able to demonstrate why it's so important that, at least for planning purposes, you consider not collecting the benefits at the same age. So the second scenario, and this one perhaps looks a little more straightforward, at least to some of you, but that may actually not be the case. So our spouses now are the same age. Both are 67 years old. And same assumption, we assume the wife is going to outlive her husband by 10 years. So if both collect at 67, the present value is $1,588,000. If the wife collects at 67 and the husband collects at 70, the present value is higher for exactly the same reasons we discussed a moment ago, $1,850,000, $262,000 more. Now, in scenario C, both of them collect the benefits at age 70. So both of them wait for 3 more years. The present value in this case is $1,945,000, which is $357,000 more than scenario A. So if you just look at the numbers, if you just look at the graphs, well, wouldn't you say that scenario C is the best one for them because it creates the largest present value for the family? Well, perhaps that's the case, but we should dig a little deeper. So if you compare scenarios B and C, if you compare the present value of the two scenarios, the difference between them is $95,000. So you take 357 and subtract 262. But in order for them to accomplish that, the wife would have to leave essentially $130,000 on the table in uncollected benefits. So you see, in the long run, scenario C is perhaps better than the previous two, but in the short run, again, there's a pretty significant cost of making that decision. So at the very least, again, we'd share this information with this couple and see what decision they want to make. So it's not that black and white, even when the numbers may appear to tell you so. All right, so changing gears here a little bit. So the restricted application claiming strategy, this will be really quick. This is the final or the last webinar when we'll mention the strategy, simply because it doesn't apply to the vast majority of people at this point. It only applies to those who were born prior to January 2nd of 1954, and they're in a very specific situation. But just for the purpose of being comprehensive, the way it works, the lower earner spouse would apply for the benefits. He or she would actually have to apply to start the process. Then the higher earner spouse applies for restricted application on spousal benefits. That's important, not on his or her own. And then when the higher earner reaches age 70, which in this case would be a year from now, for those who were born prior to January 2nd of 1954, he or she would switch to his or her own benefit, which, as we discussed, increases by 8% per year. Now, without, again, going into much detail, this is clearly a loophole. Let's just say it as it is. So this strategy was essentially discontinued, I'm going to say 5 or 6 years ago. And again, this is really the last time we're mentioning it. So what if you're divorced? What rules apply to you? And would you be eligible for benefits? Well, to qualify for benefits, your marriage needs to last for at least 10 years. You need to be unmarried at the time of applying for the benefits. You have to be at least age 62 or older. And the assumption here is that your ex-spouse is entitled for Social Security benefits, which is the case, I would say 99% of the time. Now, the other important piece, which is what makes this conversation a little more challenging, the assumption is that the benefit on your own work record is less than the benefit that you would receive based on your ex-spouse's work record because of the deemed filing rules. So you really have to consider that. So how much are the benefits? Well, that depends, of course, on your ex-spouse's benefit in this case. If you're at your full retirement age or FRA, you'll be eligible for payments that are 50% of your ex-spouse's benefit. But if you begin collecting them prior to your full retirement age, they will be permanently reduced. And again, keep in mind the deemed filing rules. So you can only collect one of the benefits. What if you're widowed? What are the rules in this case? Well, I'll say the rules are more liberal in this situation. You need to be married for at least 9 months, so not necessarily a long marriage, and you need to be at least age 60. So it's not 62, by the way, or age 50 if you're disabled. So if you reached your full retirement age, you would be entitled to 100% of the benefit of your deceased spouse, and that percentage would be reduced if you begin collecting the benefits prior to your age, prior to your full retirement age. Now, compared to the divorce benefits, this is different. Here you can actually collect your deceased spouse's benefit and then switch to your own. So the deemed filing rules do not apply here. But what applies here is the earnings test. And this is one of those, I'm going to say, relatively common mistakes when we work with widows. They try to apply under their ex-spouse's account, and then they end up receiving essentially nothing, because if they continue to work, the earnings test still applies up until they reach their full retirement age. So again, this is something for you to keep in mind, but I would say in practice, it doesn't always work that well. Judy?
Okay. There is a lump sum option. Many people are not aware of this option. Essentially, if you have reached your full retirement age, and you've delayed receiving the benefit, you can actually go back and say, "Oh, you mean I could have filed back at, when I reached full retirement age, and receive a lump sum payout up to 6 months of the retroactive benefits." So, for example, if your full retirement age is 66 and you claim benefits at age 67, you can request 6 months of the retroactive benefits payable to generate, some cash, which would be subject to tax. And then you could then suspend your benefits and earn delayed retirement credits up until age 70. So this would be, a scheme, if you will, if you wanted to generate some cash. However, I just want to caution you, if you do that, it does actually put your retirement age back, right? Back to the 6 months, retroactive. It's rolled back, so it reduces your benefits. There is a cost associated with doing it. I would just say don't rush into a decision like this, because if your benefit is lower, you may not have wanted to do that just to get the 6 months lump sum, because it impacts then your benefit, throughout your entire retirement period. So something just to let you know about. Run the numbers if you think that you might want to do it. It's out there, but generally we don't see it happen very often. Okay, what if I make a mistake? This is very interesting, and I have worked with clients where they've come to us, they've gone ahead and they've started to withdraw early, and then we've done their financial plan, and we've come, mutually to the conclusion that maybe that was a mistake. So you can correct it. It has to be from the time that you first made the claim. It has to be less than a year to when you decide to withdraw your claim, and you must be under your full retirement age. You do have to pay back all of the Social Security benefits received, and it may require an amendment of your tax return depending on whether or not it crossed over a calendar year, and you can only do this one time. But if you're sitting there thinking, "Oh my gosh, maybe I shouldn't have have claimed, prior to my full retirement age," if you meet this criteria, think about it and think about, possibly withdrawing the claim and getting the higher future benefits for a longer course of your retirement. You can also suspend, so you can claim, and then you can say, "Well, I just got this great work opportunity. I think I'll go back to work. And, I think I'll suspend. I don't need the money. Suspend it and let it grow." You can do that. You can let it grow. You have to have reached full retirement age, but less than age 70. So in between those 2 points. And the benefits will be suspended, but which also includes spousal benefits. So consider the impact on that. In Medicare Part B premiums are typically paid out of your Social Security benefits. So if you decide to suspend, if you're not receiving a Social Security check, then you're going to end up having to make those Medicare premiums out of pocket. And then that would allow you to receive the delayed retirement credits to increase your future Social Security benefit, and something to definitely consider if you're in that situation. And I think, Alex, that puts us to frequently asked questions.
Actually, Judy, I'm going to slide in here with the third CPE poll, which I'll leave up on the screen for about 30 seconds.
Thank you, Jill. Thank you, Judy. It's actually perfect timing. We have 11 minutes for questions. So as always, please ask your questions in the chat box. We will read your questions out loud. We will not mention your name for privacy purposes, and we'll try to address your questions. We had close to actually more than 40 questions that were submitted to us prior to the webinar. We'll try to address 5 or 6 of them today. Now, one thing I'll mention up front, we had several great questions that include numbers, that include specifics about that person or that family's situation, but those are not the types of questions we can address in this webinar. They require at least some analysis. So please reach out to us separately. We'll be happy to schedule a consultation with you to address those questions comprehensively. But again, today we'll try to cover perhaps more general questions.
Yeah, broader questions, absolutely.
Broader,
right.
That's perhaps a better way of saying it, yes.
Yep.
So can I still receive Social Security benefits if I live outside of the US? The answer is yes. You're entitled to receive your Social Security benefits, assuming you qualify, regardless of where you live in the world.
And I'll just add to that, there are many expats actually that decide to retire, say in Mexico. I think I read that was the #1 destination for expats. You still have to file a U.S. tax return and pay the income tax. Just wanted to throw that out there. But your cost of living might be considerably lower, or will be considerably lower, particularly in Mexico. So that's why many expats do decide to live abroad and collect their Social Security.
Absolutely. We actually have 2 clients who live in Mexico at this point. So, okay, so what happens to my Social Security benefits when I die? Well, the short answer is, and we talked about this earlier, if you die with an eligible spouse or dependent children, Social Security will pay survivors' benefits to them. And again, in terms of planning, earlier I talked about this hedging strategy, especially when we work with spouses. Again, this is a very powerful strategy that you need to keep in mind, again, specifically when you're married. If you plan to work until age 70, is that the point where you must take Social Security? Judy?
Yeah, the answer to that is yes. I think we've explained that over the slide. You definitely need to take it starting at age 70, but there's no penalty for continuing to work. And other than paying the income tax, there's no penalty on the amount of your benefits.
That's right.
And how is Social Security tax for state income tax purposes? Sorry, Alex, I'll just take this one.
Please.
It depends on your state of residence. 37 states and the District of Columbia do not tax Social Security. So you can look up to see if your state is one of those. I will say DC, Maryland, and Virginia are all included in that. And so that's something to consider when you're putting together your budget for retirement as to how your Social Security would be taxed.
Thank you, Judy. Okay, so again, we had quite a few questions. So Judy and I picked some of perhaps more interesting questions here. So the first one is maximizing Social Security options with volatile markets, which I would say is a very timely question. So it really made me think, because I can really think of it both ways. So let's say you're concerned, about the market volatility and you expect it to continue, let's say, in the future. So one of the options you may want to take, assuming again your full retirement age and it makes sense for you to actually collect your Social Security benefits, is to begin collecting them. And essentially, as a result of that, well, a portion of your budget would be covered by the benefits, and you would be able to essentially keep the funds invested so that the market volatility would not have much impact on your cash flow. Or actually vice versa, which is interesting, meaning that if you're concerned that perhaps your portfolio is now depressed in value, which is most likely the case for most people, then deferring the benefits to age 70 would perhaps make sense for you so that the funds can continue recovering. So there's multiple ways of looking into this. Judy, have anything to add? It's just an interesting question when you look at it from this perspective. Best way to manage Social Security benefits and 401k. What do you think about this one, Judy?
Well, so when we prepare retirement projections for clients, we outline all of their sources of income, which would include, of course, retirement benefits from 401k plans, or say you're a federal government, your FERS and your FERS pension. So basically, you want to think about how the income is going to be taxed, and how the benefit may change over time. And we, present value that, and then basically do various different scenarios for clients, so you can optimize, what is best for you. We did mention earlier about IRAs and the advantage of being able to make the qualified charitable distribution from IRAs to help lower your tax obligation. That's not available in regular retirement plans. It has to be an IRA. So there are pros and cons of different sources of income, and it certainly should be, you should look at the entire full financial picture in making the decision about which to draw first and when and how.
This is amazing. Again, reading all these questions, it's another confirmation why making your Social Security decision is not only about the actual decision or the decision itself. There's so many factors that will likely have sometimes very significant impact on that. So before and I see there's multiple questions in the chat box, just this one is quite interesting, specifically for perhaps those who are self-employed. So sole owner S Corp, are only the W-2 wages counted in calculated benefits? Judy, what do you think about this one?
I love this question. Alex and I were talking about it yesterday. Thank you so much for whoever brought that up. Traditional tax planning, as a CPA, we in an S Corp, we set, the individual shareholder's salary, and then the rest of the profit is distributed through what's called a K-1 and not subject to Social Security tax. So it's only the W-2 wages that is included. Now, in practice, I typically have our S Corp clients pay through their salaries the maximum taxable earnings ceiling. So, for example, in 2023, we said it was 160,200. So that would be their salary. They're getting their maximum, credit for Social Security purposes, and then to the extent that they have profit in excess of that, it flows through and escapes that taxation of the additional Medicare tax. Same thing applies for a self-employed person that files a Schedule C, or has a disregarded entity LLC that files a Schedule C. We're always saying, oh, well, great, you can, purchase an automobile or purchase equipment or do other year-end tax planning to lower your tax. But often that decision, sure, it saves you income tax, but it's counterproductive in terms of your retirement goals in maximizing your Social Security contribution. That's assuming that you think Social Security will be there for you when you retire, which was where we started off this conversation. But it is an excellent question. Thanks for bringing it up. And it certainly means that nothing you do should be done in a vacuum. You really got to look at the whole picture.
Judy, I'm going to launch the final CPE poll of the day. So if you haven't had a chance to answer three of the polls so far for CPE, please submit your fourth poll here.
All right, so 2 more minutes. How about 2 more questions? Since again, we have so many of them. So here's one from the chat box. If my husband and I have essentially equivalent payouts for Social Security and he is 2 years older, should I start taking Social Security benefits first and have him wait? So I guess I'll comment on this. Potentially would be my answer. So again, without necessarily going too deep here, females on average are expected to outlive males, and in this case, yeah, the male spouse is 2 years older. So this would be one of those hedging strategies. Essentially, when the female spouse begins collecting at her, let's say, full retirement age, and then the male spouse defers to age 70, with the goal of, again, of the female spouse inheriting her husband's benefit at some point in the future. This will likely create a higher present value versus, again, 2 of you collecting the benefits at the same time. Anything to add, Judy? So again,
Oh.
one of those scenarios that we covered today. All right, another one. If husband is younger than wife, but husband's earnings were and are more, should wife wait until husband turns 70, or should wife start at her 70, then switch to husband's when he turns 70? Okay, a little bit of a, again, I'm happy to, somewhat of a convoluted question. So you cannot switch to your husband's benefits for as long as he is alive. If I understand that question, you can inherit his benefit. Now, if based on your record, your benefit is less than 50% of his, you can begin collecting under his record at your full retirement age. Maybe that's what you're asking. Judy, correct me if I'm wrong. The question is somewhat convoluted.
Well, I'll just I'll just add in there that when someone dies, if the higher if the spouse that dies has the higher benefit, the spouse can then switch to that higher benefit, but they lose their benefit, right? So you don't get double dipping. And I think that's something that's very important. And actually, when we're preparing retirement projections for clients that have like significant age differences, or maybe they have chronic health issues and, one is not expected to live, quite as long as the other, you have to look in this, because you no longer are counting the Social Security benefits of both of them. You're only including the highest of the two. So something to actually, crunch the numbers and puzzle out.
Absolutely. All right, so it's 12:01. Again, if anyone has any other questions, especially if they require more of an analytical approach, feel free to reach out to Judy or myself. We have multiple webinars in the first, well, I guess this is also the second quarter of the year. On February 9th, Judy and I will talk about Medicare and the Inflation Reduction Act. There were actually quite a few questions on Medicare, so please consider joining that webinar. We'll have our quarterly market update on February 16th, where we'll be updating everyone on the markets and our strategies going forward. March 9th, we're going to have a webinar on real estate, especially in this market. Hopefully, it's going to be helpful to many people. And then again, on April 20th, we'll have our normal quarterly market update webinar. Judy, we will
and
also
our Secure
have
Act too, right? Yeah.
Yeah, it's not here, but we'll also talk about the son of Secure or Secure Act 2.0.
That was basically passed in the closing days of the last Congress in December. And it does, it does change planning for IRA distributions and other just retirement savings. So definitely that will be one to tune into, and we'll be getting information out on that. I think probably, Joe, in the next week or two.
That's right. It should be pretty soon.
Yeah. All right. Well, thanks everybody for joining us. We very much enjoy presenting to you, and I hope that you learned something. And if you have any other questions, feel free to reach out to Alex or myself. Have a great day.
Thank you, everyone. Have a good day. Bye-bye.
Bye.